Well, our next guest says the value rotation can continue and new highs are coming with it. Let's bring in Marko Kolanovic, Global Head of Macro Quantitative and Derivative Strategy at JPMorgan. Marko, it's always great to see you.
Thank you.
So you have a bunch of skeptics on the desk in terms of this rotation. So what has, to answer Guy's original question, what has changed to make you believe that this value rotation is here?
Well, first, positioning is extremely low. So if you look at the sort of hedge fund equity exposure, it's about 0th percentile, so close to all-time lows, matched in 2008. If you look at the individual investors, so AA, II, bull bear sentiment, it's basically the same level it was 2008. So a lot of bad things are already priced in the market, right? Like, and positioning is very low, then generally there's upside. That's pure mechanics. This is not even economics 101. So that's
it was AP economics.
Okay, sorry.
That was teasing.
So that's something that we can sort of hold on to, low positioning, and then you had some positive developments, what Tim mentioned already. So you have a services in U.S. You had a little bit on Brexit, a little bit on Italy, a little bit on Hong Kong SAR. And then you had this October negotiation. So if we have like 2 to 3 weeks before October, where we still have a buyback full force, when the VIX declined from 22 to 14, 15, so all the sort of systematic folks will actually relever, and you have a discretionary investor who is basically zeroed invested in the market. So that's why we think it can continue. Now, why the value rotation can continue? So if people add to market, the first thing they'll close the shorts, and why? So net positioning is 0th percentile. But gross positioning, gross exposure, according to JPMorgan Prime, is 99th percentile. So you have like a massive long-short trade where people are super long, low vol, quality, momentum, and growth, and they're super short value. So if they want to increase the net exposure, I don't think they're going to triple, quadruple on software and stuff like that. They'll close some of the energy, oil and gas, some of the EM, some of the banks, and other value stuff. So we think that this can continue. Okay, so it can continue in our view until October. In October, basically, you have negotiations. Anything can happen, right? So if the negotiations blow up, we go back. If negotiations actually produce some results, I think this can last for a full year, like in 2016 and 17, when it lasts more than 18 months.
So that's a very strategic trade.
So strategic is until October.
Right.
And in October, I think we need to reassess. If there is actually progress towards a trade deal, this can be new 2017 H2 plus 2016 H2 plus 2017. So it can last another 18 months. If we have more of the same, no resolution, back and forth, tweeting and stuff like that, then we go back to where Guy thinks we'll go.
So when you say we could go back if there are stumbling blocks in trade, does that mean that we retest the 10-year yield lows? Do we go back to that sort of
on the 10-year?
Scenario?
Yeah, on the 10-year stuff, we said we wrote something already in August that big part, most of the 10-year move was sort of purely technical. So mortgage hedging, option gamma, insurance liability hedging, CTA going up to 500% on the long bonds and stuff like that. So a lot of it was technical, not necessarily, we're going to recession next week or next month. And what Tim said, sort of like when the services came out and even the sort of jobs number, we're not going next month. Who knows? If there is no trade deal, we as well may go into recession. But next 2 weeks, I don't think we're going into recession.
So Marko, Tim just mentioned the 10-year Treasury year on year is, almost got cut in half, right? And we know where Fed funds is; it's still above 2% here. So let's assume that some of the data does stabilize a little bit. Some of the conversation around trade is okay. What does that mean? Are we going to start seeing rates go back up quickly?
I think so.
And then what does that mean for equities? Because there was a time when everyone's convinced that rates can go up and stocks can go up at the same time.
Yeah, and they did all the way until 330 or in 10 year, right? So I think sort of from 140 to 170, I think is all positive. I think probably to 250 is all positive, and to 3 like we had last year in April. So yeah, at some point, but we're not yet there, far from there, right? We are at 170, right? So sort of let's kind of think when we get there and if we get there. But I think sort of yields going higher is good for value. I think it's good for stock at this point. Now bonds and equities are trading risk on, risk off. Fed is cutting, so it's not that Fed is going to hike and rates are going to shoot up and equity is going to sell off. Fed is cutting, pretty much every central bank in the world is cutting. So there is a massive monetary stimulus. Keep in mind, monetary stimulus comes with a lag, hits the equity market with a lag like 3, 4, 5, 6 months. So if we can bridge October, November, and December, you'll start seeing actually the monetary stimulus feeding into equity market. You also see credit impulse from China also lag like 5, 6 months. You'll see that feeding. So again, I think we're vulnerable in October if we blow up again, like we did August 23rd with a tweet, right? But if these things can somehow go through in orderly fashion, ideally some progress being made, I think we can go. Look, market didn't move for pretty much 18 months, right? So I wrote that's like 20th percentile, so very poor performance. Like in what you mentioned, Russell is actually flat since October 2017. I mean, maybe last 2 days break that range, but for 2 years we didn't move, right? Like, so people say all-time highs, can we go higher? We really didn't move for 18 months or about, like, so we could break out again if we have some normal sort of political environment. Central banks are easing and positioning is pretty much close to zero.
Marko, great to see you,
Thank you.
always. Thank you. Marko Kolanovic, JPMorgan.
Compelling argument. I mean, it's the Bulls are in charge right now, and he makes it, as did Tim. They make a very compelling argument. I mean, my only pushback is, again, things might have gotten better on the margins, but the problems that we were concerned about, at least that I was concerned about, really haven't gone all that away. And the fact that now, to Dan's point, you're having a president saying that we should be at zero, if not lower in rates. I mean, that to me is somewhat problematic.
All right, let's get to the story that we're following for you in the after-hour session. Oracle shares are down, reporting earnings a day early, with CEO Mark Hurd announcing that he will take a leave of absence for health-related reasons. The stock is now down 2%. It had been down by as much as 4.5%, 5% here. So it's recovered 2% here. It's recovered a bit. What do you make of this?
Yeah, I think that obviously it's aftermarket here, and investors don't like these sorts of surprises, and we're hoping that Mark Hurd's just fine. But I think the results probably look okay. That was probably a knee-jerk reaction. I think it's important to go back and remember that last quarter, that Q4 that they reported, was pretty good. The stock broke out to a new all-time high. So here it is back up at those levels. I think if you like value and you like some of the secular trends that this company's involved in, then you probably like Oracle at $55.
The team without Mark Hurd is pretty solid. I mean, Larry Ellison is still there. Safra Katz is still CEO. Karen,
co-CEO, right? So that's interesting. Rarely do you get sort of two, a triumvirate, and two of them are very seasoned, and obviously Ellison, as a founder. So I think from that standpoint, I think investors should feel okay about it. I'm curious though about, I don't know what the duty of the board is. How much information do they need to give? It's this came up a lot when Steve Jobs was sick. I think the board then handled it very poorly, not good disclosure, and then later more disclosure. I don't know what the duty is,
so
but
more,
this brings
more
up a
detail
question.
around the health-related issues.
Right.
And therefore, let's not read too much into it. Is that the conclusion? Because they feel that they have to do it in an overly compliant board environment that most boards follow, not all of them. Is that what you mean?
Well, I don't know what to make of it. I don't know what their duty is. I don't know what they feel their duty is. But coming back to the original point, I do think you're in good hands still with both Ellison and Safra Katz there.
So quickly, Oracle, the stock, we've spent so much time talking about software failing and all these high, essentially these high growth stories that really have been the byproduct of this sell-off and rotation. Oracle is not a high multiple stock. This is a value play in the middle of the software space. I like it.
Guy?
And the margins were better than the street was expecting. Listen, you can quibble over EPS, maybe a slight miss in terms of revenue, but margins are hanging in there, better on the cloud side of things. So at 13 times, I think the sell for the magnitude we saw 20 minutes ago is overdone. Respectfully, I think, Larry Ellison and Safra Katz are more than capable of picking up the slack in the interim.
Yeah, guys, but not a growth story either. They may manufacture EPS growth, but this is a low single-digit sales grower, and they need to do it by making massive acquisitions every few years. So to me, I think they're just kind of different buckets when we're thinking about some of the software names that are a little bit more exciting.